Hello, and thank you for joining us for this week's market briefing. Today we will discuss how investors' attention has returned to lower risk assets and opportunities to generate income following the strong rally in the stock markets. We hope to provide some general perspective on the opportunities and the broader search for yield in today's market. Let's start by looking at the long-term trend in interest rates going back all the way to the 1950s. As we can see, interest rates have been declining for decades, providing a tailwind to total returns earned from bond portfolios. But as interest rates reach lower and lower levels, the return outlook for bonds becomes more challenging. After troughing in 2016 and beginning to recover to higher levels, interest rates have again fallen to new all-time lows this year. So what should investors expect for interest rates and bond returns going forward? The Federal Reserve responded aggressively to the coronavirus pandemic by quickly lowering interest rates and initiating sizable programs to support the financial markets. Back in March, we saw the Federal Reserve drop its target interest rate to zero, reactivate many crisis-era liquidity programs, and quickly expand its open market purchase activity. These measures were extremely important to support the normal functioning of the financial markets during this time of stress. The Fed has clearly indicated that it intends to keep its target interest rate at or close to zero for the next several years. As we can see on this chart, investors immediately priced in the Fed's low interest rate commitment for the next 2 to 3 years. So if core bond yields are likely to remain low for some time, where else can investors look for yield? We are now looking at a snapshot of some yield alternatives as of the end of May. This chart shows a wide range of possibilities, each with varying levels of risk. Starting on the far right side, it notes intermediate treasury bond yields of less than 1% as the starting point for low risk income. Next to that, we see U.S. stocks with a dividend yield of around 1.9%. From there, we would highlight U.S. high yield and MLPs as useful examples. All of these sectors have been hit hard by the economic impact of the pandemic, and yet each has responded somewhat differently and provides varying levels of potential risk and return. For instance, bonds classified in the high yield category have received direct support from the Federal Reserve's corporate credit facilities, and yields there have come down towards 6.5% to 7% today after reaching as high as the low teens during March. On the other hand, energy infrastructure related securities such as MLPs still carry a fairly high yield in the teens given less direct support from the Federal Reserve and significant unknowns regarding the future demand and supply for oil. Hence, the yields in that sector continue to reflect the significant risks. There are many options to consider in the search for yield, each with varying degrees of risk. We are here to help you navigate through these potential opportunities and construct an asset allocation and portfolio that fits your goals. From all of us here at RMB, thanks for tuning in. We hope you're able to join us for our next market briefing.